So welcome to session 3 of the Startup Money Playbook. And if you may recall, this is a 30 session journey where we are building our complete, understanding of how money works in startups. So today's focus is going to be on the balance sheet. I know that in session 2, I said I would discuss cash flow, but I feel that it's very important and critical to understand balance sheet first. So what your business owns versus what it owes is what we're going to discuss. And by the end of the session, you will be able to read any balance sheet, understand the financial position, and evaluate business strength instantly. So let's move to the next slide. So very simple. So we broke down the 8 key lines, if you may recall. First is the revenue, the top line. Subtract the COGS and you get gross profit. Okay, you subtract operating expenses and you get EBITDA. You subtract the depreciation and you get the net profit. We also looked at the example of Study AI, month 1, where the revenue was 19,800 and the gross margin was 97.5%, with net margin was 57.7%. That's very profitable. Okay, resulting into the net profit of rupees 11,416. And the key insight was margins matter more than revenue. A 10 crore business at 50% margin is stronger than a 100 crore business at a 0.2% margin. Today, we move to the second financial statement, that is the balance sheet. So in this particular session, we will understand the concept, break down assets, liabilities, and equity, build a real balance sheet, and connect all the 3 financial statements. After this session, you'll be able to read any balance sheet, calculate working capital, judge financial stability. So, the balance sheet is a photograph. Not over a month, not over a year, and it is at a single moment in time. Example, 31st March 2025. At the exact moment, what does the business own? What does it owe? What belongs to the founder? Let's compare. Profit and loss covers a period, like a semester result. Balance sheet is a snapshot, like your bank balance today. P&L shows revenue, costs, profit. Balance sheet shows assets, liabilities, and equity. Very strong fundamental equation. And this has never been changed over years. Assets is equal to liabilities plus equity, or the simplest way to remember, equity is equal to assets minus liabilities. Assets are everything in your business. So Study AI includes, laptop worth 50,000 rupees, cash 1 lakh, 4,362. There are some prepaid expenses. So total assets is equal to sum of everything with this value. So what are current versus non-current assets? Let's break it down. Current assets convert to cash within 12 months. Any asset, any value that you actually possess, which can be converted into liquidity, real cash, you can buy something with that within 1 year. That's called the current asset. So in the context of Study AI, cash and bank, right, is 1,04,362 rupees. So RN can buy anything, right? Accounts receivable. There's no accounts receivable. I mean, customers have already paid. There are no inventories because his business is all the downloadable, study materials. There are no prepaid expenses, or in fact, it's very few, very less, that is 600, right? So total current assets is equal to 1,04,962. But what are the non-current assets? As the name suggests, non-current. which means these are long-term assets held for more than 12 months. Take the example of a laptop. The cost of the laptop is rupees 50,000. And if you may recall, this 50,000 rupees laptop will no longer be sold at 50,000 rupees in the next year. There will be some reduction, some depreciation. So the accumulated depreciation could be rupees 8,334. Net value will be then 41,666. Now you may wonder, where is this 8,334 has come? So there are certain assets which have already been defined, right? And the depreciation in case of laptop is 40%. So every year it reduces by 40%. Let's understand depreciation deeply. Cost of laptop, 50,000. The useful life, over a period of time which this laptop can actually work, is 36 months, that is 3 years. So the monthly depreciation will be 50,000 rupees divided by 36. That's going to be 1,389. After 6 months, which means you multiply this 1,389 into 6, you will get 8,334. So the book value now will be 50,000 minus this depreciation, that is 8,334, that is 41,666. The very important thing to note here, depreciation actually reduces profit, but no cash goes out. So liabilities are everything you owe, and nobody wants to owe liabilities. Study AI liabilities include loan, maybe, GST payable, or deferred revenue. This is just an example that we are taking. So the current liabilities then would be the GST payable, which is 3,785, and this is something that he can't keep with him. GST is the tax that he has to pay to the government. Then there's advance tax, 20,228. Then there's the deferred revenue, which is 9,786. It's annual subscription collected, but not yet earned. Then current position of loan will then be 15,756. This is the next 12 months loan principal repayments. So the total current liabilities will then be 49,555. Long-term liabilities, simple loan, which is 27,102. So what you see actually here, there's an equation that you see at the bottom. That is, working capital is equal to current assets minus current liabilities. If the working capital is negative, the business cannot pay its near-term bills. Put current liabilities is equal to 0. And what you get is working capital is equal to current assets. Right? Now, let's talk about the GST payable. So if you collect, let's say, rupees 17.82 as GST, that is not the money you have. It belongs to the government. The deferred payment, the deferred revenue, this is the customer pays 799, which is upfront, and you earn only 66 rupees 58, this one. So the remaining, which is liability, is 732.42. So it's very simple. When RN charges rupees 99 and there's a GST, which is close to 18%, the value becomes 116.82. This entire 11682 is not his. Okay, the 17.82 will definitely go to the government. Right. Okay, so the advance tax is very simple. Tax provision, that is rupees 20,228, and you set it aside monthly to avoid shock later. Okay, so what you see actually is RN's business is completely profitable. and he must pay income tax quarterly in advance, which is 15 June, 15 September, 15 December, and 15 March, every quarter. In India, the financial year starts from 1st of April and ends the next year's, March 31st. Each month, he provisions 1 by 12th of his estimated annual tax bill as a liability. This way, there's no surprise at the quarter end, and the money is already set aside. So the question is, what is equity? This is something that belongs to the founder, the residual, what's left when you subtract everything owed from everything owned. Recall the equation. Equity is equal to assets minus liabilities. In the case of study A, the capital invested at the beginning, if you may recall, was rupees 10,000. The retained earnings is 79,926. So the total equity will be the sum of these two, which is 89,926. So month 1 equity, 10,000. Month 6 equity, 89,926. What is the reason? Because profits are retained. Very simple. And you can see the example. 11,416 is month 1 profit. Month 2, 14,846. By the time he's in month 6, the retained earnings 79,926. So what is the growing equity means? Growing equity is essentially this equity that grows every month that the business is profitable, because net profit flows from the profit and loss directly into retained earnings on the balance sheet. Month 1 equity, which is just the capital, 10,000 rupees, and month 6 is the combined one, that is all the profits plus rupees 10,000, that is 89,926. And once he, let's say, raises the first round, first capital, external money that comes in seed round, right, which is 164926, and we'll see later, right, this will be the combination of the capital and the venture capitalist money plus the earnings. Okay, so what we're going to do is, let's build it live. Let's build study A's balance sheet. So what you see are the two boxes. The blue one are the assets and the red one are liabilities and equity. Again, assets is equal to liabilities plus equity, and this is how in Excel sheet we represent the balance sheet. Let's start with the assets, the current assets. What are the current assets? Something that can be converted into liquid cash. So one is the cash and the bank balance. That is 1,04,362. There are no accounts receivable. Prepaid expenses 600. So the total current assets 1,04,962. But there are non-current assets. The laptop that is there, rupees 50,000, and there's an accumulated depreciation which will keep reducing, right? So 8,334, and we saw the calculation. So the next net fixed asset will be 41,666. Let's look at the liabilities. First one is the current liability and the GST that he has to pay, which is 3,785. The advance tax provision 20,228. There's a deferred revenue we saw, rupees 9,786, and the current position of loan 15,756. So the total current liabilities 49,555. The long-term liabilities, of course, the laptop loan, which is long-term, paid after a year, so 27,102, and that's the only liability that is actually left. Okay, so what you need to actually check is very simple, the equation. Total assets 1,46,628. What is that? The cash 1,04,962 plus fixed. You can just go back. Just add 1,04,962 plus 4,1666 and you get 1,46,628. Is it equal to the total liabilities and equity? The liabilities are very simple. The current liabilities 49,555 plus the long term, that is 27,102. Let's go back and read it again. Plus the equity, which is the capital plus the retained earnings. And you can actually verify this is the value. Hence, the balance sheet balances. This is the golden equation. Not a single digit can move here and there. This equation must always hold true. So there are certain current ratios that we will have to study, right? And current ratios formula is very simple. Current assets divided by current liabilities. And current asset, we have 10496. And if we divide by current liabilities, we get 2.12x. Our target, if you remember, was to have more than 1.5x. In his case, the current ratio is really good. This is something that investors actually look. Then there's something called debt to equity, which is 76,500. 657 divided by 69,971, and that is 1.1 times. This is also fairly acceptable. So equity is shown as 69,971, which is equal to 10,000 rupees capital plus 5,997 retained earnings after month 6, net profit of rupees 68,181 less prior months retained earnings. Working capital, very simple. This is the lifeblood of day-to-day operations. So working capital will be equal to current assets minus current liabilities. In case of study AI, month 6, the current assets are again 104,962. Current liabilities, you know that, 49,555. And if you subtract, you're left with 55,407. So the current ratio is really healthy. So positive working capital can pay all near-term bills from near-term assets. Healthy business can operate without any external help. Zero working capital can just barely pay bills. Very risky. Business is going to shut down very soon. Any delay in collections will always be a crisis. And what if this working capital becomes negative? You cannot pay near-term bills from near-term assets. You are already in the crisis mode, may need emergency funding, or suppliers will stop credit. And of course, you'll have to shut down the business. So, how the three statements connect is very simple. Balance sheet is a snapshot. Equation always holds, and working capital is a survival. One story, one business, three documents, and one consistent story. I think we made it very clear. So what is the profit and loss? It's over a period of time you saw the performance, right? The balance sheet on one particular date. What does the founder own? The company owns or it owes. Very simple. Assets 146,628. Liabilities are these two values that you actually saw. But cash flow statement is the reality. That's the money in the bank account. Okay. And what you see is the closing cash, that is 1,04,362, very healthy. And here is the key check. The closing cash on the cash flow statement must match the cash on the balance sheet. Always. If it doesn't, there's always an error. So, key balance sheet ratios, we've already discussed. The current ratio, it's the current assets divided by current liabilities. We already saw. If it is more than 1.5 times, very healthy. If it is 2 times, strong. Right? Less than 1 time, obviously danger. Then debt to equity, that is D to E ratio, total liabilities divided by total equity. Very easy to remember. Debt is obviously you owe, so take all the And then equity, right? Divide by equity. So if you look at it's 1.1x. If it is less than 1, it's conservative. 1 to 2x, it's acceptable. But it's more than 3x. It's high risk. Very simple, because you want to reduce your liability. As long as your liabilities are less or maybe zero, it's always good. Then comes the working capital. That's the current asset minus current liabilities. If it is positive, you can pay bills. Negative, crisis. If it's larger, it's safer. Then comes the asset turnover, which is revenue divided by total assets. And that is 0.81x. Higher is equal to using assets more efficiently to generate revenue. Then comes return on equity, ROE. Net profit divided by total equity into 100. And the value is 97.4%. Okay, if it is more than 20% excellent, more than 50% exceptional, in case of study AI, the one term that we can use is extraordinary. So avoid these mistakes. 5 balance sheet mistakes founders make. First one is forgetting to depreciate fixed assets. Okay, and the very simple fix is, if you bought a laptop, it must be depreciated every month. Failing to do so overstates assets and overstates profit. You don't want to do that. Not just in case of laptop, but any asset which is depreciation, any machinery, anything that you've bought. The number 2 is mistake that you can avoid, that you must avoid, is not separating current versus long-term portions of loans. The fix is very simple. If your loan EMI is 1,667 per month, the next 12 months, will be equal to 20,004, which is the current, and the rest is the long term. So both must be shown separately. The third one is, if you treat GST collected as your revenue instead of showing it as liability. The fix is GST sits in a liability account. Every rupee collected on behalf of the government must be paid as GST payable until remitted. The fourth one is zero share capital when the business is operational. So this is what you need to avoid. The fix is very simple. If you spend personal money to start the business, that is paid up capital. It must appear in equity. A balance sheet with zero equity but real assets doesn't balance. The last one is the balance sheet doesn't balance and nobody notices. The fix is very simple. If assets are not equal to liabilities plus equity, there's an error somewhere. Do not present an unbalanced balance sheet to everyone. It destroys credibility immediately. So what you learned in this hour is these 4 things. Balance sheet, you understood as a photograph, because P&L covers a period, the balance sheet covers a single day. It shows assets, liabilities, and equity at one specific moment. The one golden equation that you will always remember is assets is equal to liabilities plus equity. And this has always been true over ages. Third one is current versus non-current is a survival signal. Current assets and liabilities due within 12 months determine if the business can pay its bills. Working capital must always be positive. And we saw this example, study AI 1.6, the assets, the overall rupees, 1,46,628, right? And if you split, the liabilities are 76,657 plus the equity 69,971. We built it live, every line explained. The current ratio was 2.12x. The ROA, return on equity, that we saw, that is 97.4%. Extraordinary. So your action for this week, build a simple balance sheet for any business. Pick any business, your own, your friends, a hypothetical one. Go to AI, just Google it, ask it to create, give it to you some sample idea, and you can start building it. Don't ask it to create the balance sheet because you're here to learn. List all its assets, cash, equipment, money owned by the customers, prepaid costs. List all its liabilities, loans, bills unpaid, taxes owed, advanced payments received. Calculate equity, assets minus liabilities. and do a quick check. Do assets is equal to liabilities plus equity? Always. LHS is equal to RHS. If yes, you've built a balance sheet. So there's a template that you can actually download from this Google Drive. In fact, not just this template, but all the templates that we'll be using. It's a pre-built balance sheet template with both sides, automatic totals, balance verification, and current ratio calculator. Balance sheet tip of the week is reconcile your balance sheets monthly, not annually. A balance sheet that is updated monthly tells you exactly how your net worth is changing. Is equity growing, profitable business, or shrinking? Losses are piling up. That's the most important trend to track. And in the next session, of course, we will definitely study the cash flow statement. Where did all the cash go? And this is where you will actually understand operating versus investing versus financing cash flows. The three sections of the cash flow statement and what each tells investors. There's something called an indirect method, why depreciation gets added back. The mystery of why non-cash, because depreciation is non-cash, are reversed when calculating cash from operations. Study AI's full cash flow statement bill life. All three sections completed and the closing in cash reconciling with the balance sheet. I've completed this session 3, and you can now read any balance sheet in the world, I believe. See you in session 4. Thank you very much for watching. Do like, subscribe. Have a great day ahead.